We are told that central banks exist to stabilize economies. The official account is straightforward. Independent institutions manage interest rates, control inflation, and act as lenders of last resort during financial crises. This is the explanation taught in economics courses and repeated in policy briefings. The mandate is public, the mechanism is documented, the rationale is rational. But there is a structural detail that does not fit cleanly into that explanation. Since 2008, the combined balance sheets of the world's major central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England, expanded from roughly $5 trillion to over $30 trillion at their peak. That figure represents assets purchased with money that was created, not taxed, not borrowed from existing savers, created by institutional decision, and it happened within a period measured in years. The official explanation accounts for the crisis response, but it does not fully account for what came after the crisis ended and what has never fully unwound. When a central bank purchases a government bond, it does not withdraw funds from somewhere else. Instead, it credits the seller's account with newly created reserves. This is not a metaphor. It is the operational reality of how central bank asset purchases function. The money did not exist before the transaction. It exists after it. What this means in practice is that central banks acquired significant holdings of sovereign debt, mortgage-backed securities, and in some cases corporate bonds and equity instruments, using money that carried no prior cost. The Bank of Japan now holds roughly half of all outstanding Japanese government bonds. The Federal Reserve, at its peak, held around $8.5 trillion in assets. These are not abstract statistics. They represent claims on tax revenues, real estate, corporate earnings, and they are held by institutions that answer to no electorate. The question is not whether this happened. It is documented in public balance sheets. The question is what it means for the relationship between central banks, governments, and the populations those governments claim to represent. The formal independence of central banks is a relatively recent development. The Federal Reserve was created in 1913. The Bank of England was nationalized in 1946. The European Central Bank began operations in 1998. The rationale was simple: remove monetary policy from political pressure. If elected governments controlled interest rates, the argument goes, they might manipulate money for short-term political gain. There is logic in this idea. But it also creates a structural condition that is rarely discussed openly. Institutions now exist that can create and allocate purchasing power on a scale that exceeds most national budgets. They operate without direct electoral accountability, and their decisions distribute economic consequences across entire populations. When central banks purchase assets, they push asset prices upward. This is intentional. It is the mechanism known as the wealth effect. Higher asset prices make investors feel wealthier. Investors spend more. Economic activity increases, but there is a complication. Asset ownership is not evenly distributed. In the United States, the top 10% of households own nearly 90% of corporate equities. So when asset prices rise, the gains flow primarily to those who already hold them. The official argument is that the alternative, economic collapse, would harm everyone more severely. That may be true, but it does not remove the distributional effect. It simply reframes it. Central bank decisions are technically public, but their internal deliberations often remain distant from public understanding. For example, the Federal Reserve releases meeting transcripts 5 years later. The European Central Bank does not publish individual voting records. The Bank for International Settlements holds meetings with no public records. The BIS was founded in 1930 to manage German reparations payments after World War I. Today, it functions as the central bank for central banks. It coordinates global banking standards and hosts regular meetings of central bank governors. The question is not whether the BIS operates maliciously. The question is what governance structure exists to ensure that coordination at this level reflects the interests of the populations whose financial systems are being coordinated. The answer is limited. The 2008 financial crisis introduced precedents that had never existed before. central banks began purchasing private assets, not just government bonds. But mortgage-backed securities, corporate debt, exchange-traded funds in some cases. Equities. The Bank of Japan became one of the largest shareholders in Japanese equity markets. The Federal Reserve began purchasing corporate bonds through emergency lending programs. These measures were justified as temporary. But temporary measures have a tendency to become permanent structures. Attempts to reverse them have repeatedly stalled. There is another rarely discussed feature of this system. When governments borrow from private creditors, they must repay those debts. But when governments owe money to their own central banks, the situation becomes more complex. Central banks return their profits to the government. So the interest payments made on government debt held by the central bank often flow back to the government itself. The debt remains on paper. But its functional character changes. This subtle distinction rarely appears in public discussions of national debt. Now a new development is emerging. Central bank digital currencies, known as CBDCs. A CBDC is digital money issued directly by a central bank. Unlike bank deposits, which are liabilities of commercial banks, a CBDC represents a direct claim on the central bank itself. As of 2024, more than 130 countries were exploring or developing CBDCs. China's digital yuan is the most advanced major economy example. The European Central Bank is developing a digital euro. The United States Federal Reserve is researching potential designs. The official justification focuses on financial inclusion, payment efficiency, modernizing infrastructure, but the architecture introduces a new capability. Digital currency can be programmable, which means money could theoretically be issued with conditions attached to its use. For example, expiration date spending category limits, geographic restrictions. Whether these capabilities are used is a separate question. But their existence would represent a fundamental shift in monetary authority. Central banking is technically transparent. Reports are published. Research papers are released. Balance sheets are public, yet the decisions themselves remain distant from most public understanding. The result is a paradox: formal transparency combined with functional opacity. The public can see the data, but the frameworks required to interpret that data remain largely confined to technical specialists. There is one moment that marked the beginning of the modern monetary era. August 15, 1971. On that evening, U.S. President Richard Nixon announced that the United States would suspend the convertibility of the dollar into gold. This effectively ended the Bretton Woods system. For the first time in modern history, the global monetary system operated entirely on fiat currency. Money backed not by a commodity, but by institutional credibility and legal mandate. The decision was announced on a Sunday evening to avoid market panic before trading resumed. It was described as temporary. It has remained in place for more than 50 years. Looking across the past century, a pattern emerges. Major monetary decisions are made by credentialed experts operating within institutional frameworks. Their decisions shape the distribution of wealth, risk, and economic security for entire populations. But those populations rarely participate in the frameworks themselves. This is not necessarily deception. It is a structural feature of how monetary governance operates. Technical authority replaces democratic deliberation. And the line between technical necessity and political choice becomes difficult to see. Central banks perform essential functions. They prevent bank runs. They stabilize financial systems. They provide liquidity in crises. But the scale of their authority has expanded dramatically. And the systems now being designed, especially programmable digital currencies, may extend that authority further than at any point in modern history. The institutions are not hidden. Their documents are public. Their balance sheets are published. What remains unclear is whether the governance structures overseeing them have evolved at the same pace as their power. Because the system that governs modern money has changed. The authority has expanded, the architecture has grown more complex, and the next phase is already under construction. Whether the public will meaningfully participate in shaping that phase remains an open question.